And so the way to think about this is there are three inseparable technologies that work together to create the cryptocurrency solution. And they are the token. Most people know about the Bitcoin token, but there are many others. The blockchain, which is essentially an accounting ledger, and the protocol, in either the Bitcoin protocol or the Ethereum protocol or other protocols. In my view, the protocol, and most people who are thinking about building companies around products in this area think the protocol is the vastly most important piece of the technology. One analogy I would use to let people understand this is, in the payments world, we oftentimes use the term the rails, a railroad metaphor. And if you were to analogize this to the railroad, the boxcar would be the token into which you embed something of value and move it from one place to another. The blockchain would be the cargo invoice, and the protocol would be the rails. And remember, the part that transformed the world was the building of the rails. I say regulators and pundits see problems as obstacles, and I see them as opportunities. So one of the things we have to do is get at the capital and energy intensivity of the Bitcoin solution in order to make this technology more useful. And also, the second problem is it can be very slow. And so there's some ideas about scaling networks off the chain and bringing fewer transactions on the chain, which will reduce the amount of energy intensity. But but let me make a bigger point here. To take a step back, there are three key elements to the Bitcoin solution to the problem of trust-free exchange, which is where this all comes from, the famous Byzantine generals problem. And they are distributed systems, game theory incentives, and cryptography. And you have to understand that those three elements come together to create this solution. So let's go back to the first, which we haven't talked about, which is distributed systems, also known as networks. One of the things in the end state of this being successful, and there's a good, this goes under the heading of something called decentralized finance, or DeFi, which you've probably heard of.
DeFi.
Right. What you're doing is taking hierarchical institutions like JP Morgan and taking out the hierarchy, the costs associated with their hierarchical control of the financial system, and turning that control over to a broadly distributed community that validates transactions and takes out a huge amount of the cost associated with running a financial system that today is based upon hierarchical nodes that have a lot of power and have a lot of pricing power as transactions occur. So my point is that if you get to that world, you're taking out and replacing a lot of the processing power that's already being used in the financial services industry. It's not a net addition. There's subtraction plus addition. You have to think about that. So if you probably look at kind of what the financial services institutions around the world use in terms of processing power, it's a very large amount of processing power as well. So I just think about that first thing. And the second thing I would say is my personal view. A lot of this stuff about liberating finance from regulation and central banks and all sorts of stuff is nonsense. This industry needs to work, has to work inside the regulatory framework. A few years ago, there was this thing called ICOs that were very popular. I wouldn't touch them with a 10-foot pole. They largely were very clearly, to me, unregistered securities offerings. And I think the SEC pretty quickly took the same point of view. In a very similar way, this industry needs to work within the constraints of the regulatory systems of the countries that they operate in, as well as the international system. That's the way it's going to thrive. And what that means is that the regulatory community needs to create smart regulation, rather than have, either try to fit this industry into kind of old forms of regulation or have uninformed points of view. So, for instance, we've seen a couple of senior officials recently say that Bitcoin is all used for illicit transactions. And it turns out that less than 2%, in many years, less than 1% of Bitcoin transactions are illicit, while U.S. cash, $100 bills, are 80 to 90% of them used in organized crime and tax evasion. So we need to get beyond those simplistic understandings.
And another element that Janet Yellen brought up
I guess now Treasury Secretary Janet Yellen brought up, was the environmental risk. And that's the pushback we're getting because of the movement, the ESG movement out there, which has maybe the SEC is questioning it in the US, but in Europe, it is very strong movement. And again, Yassine El-Mandra, our analyst, has dimensioned the kind of energy use in gold mining and the energy use in traditional financial services, including trade and settlement, right? And Bitcoin's energy use compared to those is a fraction. And if you look at where the energy use is, a lot of it is around hydropower and other renewables, but particularly hydropower. So again, much cleaner than traditional businesses running on electricity. So it's been interesting that has become such a focal point. I think this is part of the whack-a-mole. They've been losing, and so this is the next mole. And I think it's easily countered in terms of narrative.
Exactly. There should not be a narrative somehow, Mike or Kathy, to her point, that Bitcoin is somehow heating up the globe. That is not the case at all. To Kathy's point, we're seeing mining being concentrated around renewables, hydro, and often actually utilizing power that would otherwise go wasted on the grid. So, not something that people should sink their teeth too far into.
I love that narrative of solving the problem of natural gas flaring, which I'm sure people can Google and we can dig into. So we have a few.
Michael Saylor, he is the CEO of MicroStrategy and really a pioneer, I would say, in the sort of like current wave of Bitcoin, because really the first public company late last year, middle of last year, to make a point about putting some of its treasury cash into Bitcoin. The stock has soared since then. Other companies have since followed suit. Michael, thank you so much for joining us.
Thanks, Joe.
Michael, like I said, you were really a sort of pioneer in this middle of last year. I think it was last summer, saying you're going to invest in Bitcoin, some of your cash. You've done it multiple times since then. You've even gone out and sold convertible debt. How many companies have you talked to? How many public company CEOs have you talked to since then, the last 6 or 9 months or so, who are interested in sort of replicating what you've done?
Well, quite a few. I mean, I can't really share my discussions with public company officers, but it is popping up as a much greater trend in the last 6 months, and I think it's coming to the forefront of the conversation with all companies, private and public.
So you've been pretty clear on this idea that you're not in favor of holding extra cash, especially given your views on monetary policy, the dollar, and so forth. What is it, though, about Bitcoin specifically versus other alternatives, or, say, distributing extra cash back to shareholders? What is it about Bitcoin specifically that, in your view, makes it a logical asset for companies to at least put some of their money in?
Well, I mean, let's look at the big picture. I've been a public company officer for 22 years. When you could generate 5 to 6% short-term interest on treasuries, and you thought that the cost of capital was 7%, then you didn't have to consider anything other than a conventional treasury strategy. You're maybe taking a minus 2% yield per year. I think that when conventional treasury assets started yielding 2% and you had a cost of capital of 7%, which is the expansion of the money supply, it became a minus 5%. People, they grit their teeth and they got through it. That was for the past 4, 5, 6 years. Now in 2020, we've seen the cost of capital explode. It's 25% monetary supply expansion. The treasury strategies are now 0, 1, less than 1%. So you've got a negative real yield, minus 25%. That's the cost of capital. Okay, that's actually turning up the heat that's causing everyone to realize that conventional treasury strategies are broken. Now, what are you going to do? Look at the last 12 months, ROI. Bitcoin is up 461%. S&P is up 25%. If you invested all of your treasury assets in the SPDR, in the S&P index, you kept up with the cost of capital. NASDAQ's up 53%. Big tech, they're monopolies, they're extraordinary, they're staying ahead of the cost of capital. Treasuries down 7.7%. If you were holding long bonds like TLT, that's a disaster. Gold up 9%. It's also a disaster. It's not keeping up with the cost of capital. So why Bitcoin? Well, you can't hold conventional treasuries. You're looking at a negative real yield against the cost of capital of 15 to 25% a year, right? I mean, I'm not a consumer. I have to control, I have to manage shareholder value. And if you want to maintain or grow shareholder value, you're going to have to grow your assets at a rate faster than the cost of capital. So your hurdle rate is 15%. Now, what are you going to do? And I think, yeah, if you look,
I mean, it is a different definition of cost of capital that you have than, say, like a traditional accountant would have, right?
I don't think so. I think that a lot of people think about inflation. I think CPI. The cost of capital has always been in a conventional environment, risk-free, 6, 7, 8%. If you talk to any institutional investor in the past decade and you said, my idea is I'm going to invest your money at 1% or 2% or 3% interest, they would ask for it back. In fact, there's not a single institutional investor that can keep limited partner capital by promising 1 or 2 or 3% returns. So all investors know the cost of capital, it's about 7 or 8. Look, if you look at the compound annual growth rate of the S&P over a decade, it's 11.4% for the past decade. If you look at NASDAQ, it's faster, it's 17%. Big tech is better than the S&P. If you look at the compound annual growth rate of Bitcoin for the decade, it's 198%. Okay, so why Bitcoin? I have to move my money. Look, either got 2 choices: decapitalize the company or invest the money into something which is going to keep up with the cost of capital or exceed the cost of capital. So let's talk about giving the money back. Well, Joe, the road to serfdom would be for you to surrender all your assets and take a job working exponentially harder for cash, growing exponentially weaker. No family on earth would do that. No investor is going to give all their capital back to the limited partners, right? No endowment's going to work. No university, no company can function by surrendering all their capital and then working harder exponentially for a currency growing weaker. And one more point. The robots are taking over the country. We're automating everything. So for Amazon to succeed, 15,000 retailers are destroyed. For Google to succeed, 15,000 media companies are destroyed. For Apple to succeed, 15,000 device manufacturers are destroyed. So every company is competing against Google, Apple, Amazon, Facebook. These companies are dematerializing their products and they're shipping. Microsoft can bundle a product, ship it to 80 million companies over the weekend. Now, how are you going to make money if you pretty much give up all your capital and you start working to create a new product to compete against Microsoft, Facebook, Amazon, Apple, or Google when robots are taking over the world?
Let me.
First of all, it's the hardest money on earth. It's an institutional grade safe haven asset. It's gold without all the imperfections of gold on a digital monetary network that moves at the speed of light that you can program to do 1 million transactions a second. So Bitcoin is digital gold on a big tech monetary network. Why would you want it? You would want it for the same reason that you want to run electric power to your city, or you would want to run running water to your building, because civilization is based on clean energy, clean water, clean communications, clean money, right? It is an extraordinarily important thing. Now, with regard to companies, I think the real issue here is if every currency is correlated to the dollar, right? I mean, they're all trading against the dollar. So if the dollar is weakening, every other currency is weakening, and then every stock and bond and commercial piece of real estate that generates fiat or US dollar cash flows or any cash flows in a fiat currency, they're all correlated assets, and they're all correlated ultimately to the dollar. So if we create 15% more dollars every year for the next 10 years,
right,
then you've got to discount the cash flows of every other instrument by 15% a year. And it doesn't take a rocket scientist to figure out that 80 to 90% of the value in those instruments is going to be collapsing if the dollar collapses. So if you want to preserve shareholder value, you have to buy scarce assets. Now, I could look for baseball cards or Picassos or sports teams, but it's hard to buy $1 billion of liquid, scarce trophy assets. So Bitcoin is the most liquid, scarce, uncorrelated asset that you can buy if you're trying to do this in a treasury.
But
I think conventional treasury strategy is now intellectually and morally bankrupt, and it's a road to serfdom, right? And I think that what you're going to find is increasingly there's haves and have-nots, right? There's the elite that have incredible power, like the Googles and the Amazons and the Apples, and they have more money and more power and more distribution than God. And then you've got conventional businesses that have conventional cash flows, and they're being increasingly marginalized. So to ask those businesses to invest all their capital in a currency which is devaluing at 15% or 20% a year is pretty much committing economic suicide.
But the expectation,
again, it's the same thing as, why don't those investors give all their capital back to their limited partners and decapitalize under that strategy, right?